What if a single sentence, hidden inside a political headline, silently broke one of the largest commodity markets on Earth? What if silver did not collapse because of demand, or supply, or interest rates, but because metal could no longer move? This is not a story about Greenland. This is not a story about tariffs. This is a story about a system that only worked as long as nobody touched the pipes. Overnight, London was cut off, New York was sealed shut, and trillions of dollars in paper silver were left asking one question: where's the metal? Really? Because when metal stops moving, its prices stop making sense, banks stop hedging, and markets stop pretending. And the most dangerous part is this: almost nobody saw it coming. Welcome to Boring Currency Index. If you have lived long enough to watch markets rise, fall, and repeat the same mistakes, this channel was built for you. If you value calm analysis over noise and understanding over headlines, consider subscribing, not for excitement, but for clarity. And before we begin, tell us in the comments, from which country are you watching today? Let's begin. On Sunday, January 18th, 2026, the global silver market quietly changed forever. Most people did not notice it at first. The headlines were loud and almost playful. News outlets focused on politics, jokes, and familiar debates. The idea of buying Greenland became the story. The market reaction did not. Inside financial institutions, the atmosphere was tense. In offices across New York and London, risk teams began reviewing the announcement line by line. They were not interested in the island. They were focused on a single policy detail. The United States had announced a 10% tariff on imports from several European countries, including the United Kingdom. To the average viewer, it sounded like normal trade news. To the silver market, it was a warning. Silver is not priced by opinion alone. It is priced by movement. Physical bars must travel between markets to keep prices aligned. For decades, this movement happened quietly and cheaply. A bar in London was treated as equal to a bar in New York because it could be moved whenever needed. That assumption had never been tested. The United Kingdom is home to the London Bullion Market Association. London is where large physical silver trades are settled. When other markets face shortages, London supplies the metal. When London runs low, it is always dependent on silver from the United States. The tariff put that relationship at risk. A 10% cost may sound small, but the silver business runs on narrow margins. Banks do not earn large profits moving metal. They earn consistency. Add friction, and the system breaks. Suddenly, silver leaving the United States might not be able to return without a serious loss. This is why concerns spread quickly behind closed doors. Banks began asking uncomfortable questions. What happens if London needs silver and New York cannot safely send it? What happens if metal moves out but becomes trapped? What happens if the pipes freeze? Trading systems were not built for this. Algorithms react to rates and data, not to logistical barriers created by politics. Human judgment became critical again. The timing made everything worse. London's vaults were already low. Strong demand from Asia had been draining physical supply for months. The market was tight before the announcement. The tariff did not create the weakness, it exposed it. This was not a political moment, it was a structural one. And once the structure cracked, the market would be forced to decide who gets the silver. To understand why the tariff caused such damage, one must first understand how the silver market truly functions. What most investors see on their screens is a price number. What they do not see is the machinery behind that number. Silver does not trade like stocks or bonds. It trades like a supply chain under constant pressure. In this market, geography matters more than opinion. There are two centers that control how silver is priced in the West. New York represents the paper side of the market. Futures contracts are traded there in huge volumes, often many times larger than the available physical supply. London, on the other hand, is where physical silver is settled. Large bars change ownership there. Real metal moves, or at least it is supposed to. For decades, the system worked because these two centers were tightly connected. When pressure built in one place, metal could be shifted from the other. This created the illusion of endless supply. Prices stayed calm not because silver was abundant, but because it could be relocated fast enough to cover stress. Banks became the operators of this system. When demand surged in New York and prices began to rise, banks would arrange for silver to move from London. When London ran low, banks would send metal from New York. Sometimes the metal moved physically. Often, ownership moved on paper, with the understanding that the bars could be shipped later if needed. This was called a location swap. It was efficient, quiet, and relied entirely on trust. The key assumption behind all of this was simple. Silver in one place was equal to silver in another. A 1,000-ounce bar in London was treated as identical to a 1,000-ounce bar in New York. As long as transport was cheap and unrestricted, this assumption held. The market behaved as one unified pool, but that unity was fragile. The physical silver market runs on narrow margins and tight timing. Vault space, insurance, air freight, and financing costs all matter. There is very little room for friction. Even small delays or added expenses can disrupt the flow. That is why free movement across borders was not a luxury. It was a requirement. Over time, this system encouraged risk. Banks sold more silver on paper than they could ever deliver at once. They were comfortable doing so because they believed supply could always be sourced from somewhere else. London, especially, relied on this belief. Its vaults were not designed to hold endless metal. They were designed to move it. Then Asia changed the equation. Rising industrial demand and long-term accumulation in China and India began pulling physical silver out of London at a steady pace. These were not speculative trades. The metal leaving London was not coming back. Vault inventories declined month after month. The buffer grew thinner. Still, the market stayed calm. And why? Because New York remained the emergency reserve. If London needed silver, it could call across the Atlantic. The connection held everything together. That connection is what the tariff attacked. The tariff did not target silver directly. It targeted trade. But because silver depends on trade more than almost any other asset, the effect was immediate. Once movement became expensive in one direction, the logic of location swaps collapsed. A system built on circulation faced a sudden barrier, and when circulation stops, pressure does not disappear. It concentrates. This is the moment when price stops being a number and starts becoming a problem. At first glance, a tariff looks harmless. It is a percentage written into a policy document. It does not seize assets or close markets. It simply adds a cost. But in systems that depend on constant movement, cost is control. And in the silver market, that control can become absolute. This is where the situation crossed a dangerous line. For bullion banks, moving silver is not about desire. It is about balance. Metal must be where contracts are settled. When inventories fall in one location, silver is sent there to prevent disorder. This movement is not optional. It is the mechanism that keeps the market stable. The tariff turned that mechanism against itself. Under the new rules, silver could still leave the United States without penalty. But once it left, bringing it back became expensive. Very expensive. A 10% tariff on re-import meant that any silver returning from the United Kingdom would arrive with a permanent loss attached. In a business where profits are measured in fractions, this was not a fee. It was a stop sign. Risk managers understood the danger immediately. If a bank sent silver from New York to London, it might calm London's market for a few weeks. But if New York later needed that metal, retrieving it would destroy the trade's economics. The silver would become trapped. What was once a temporary transfer would become a one-way decision. This changed behavior overnight. Logistics teams were told to pause exports. Vault managers were instructed to hold inventory. Deals that relied on future flexibility were canceled. The priority shifted from smoothing markets to protecting balance sheets. The system moved from cooperation to defense. This is what turned the tariff into a weapon. It did not need to ban silver exports. It simply made them dangerous. And when risk becomes unquantifiable, banks choose inaction. They freeze. They wait. They hoard. This effect is sometimes described as a roach motel in commodity markets. Assets check in, but they do not check out. Once silver entered the United States under these conditions, no rational institution wanted to send it away. The cost of return was too high. The result was market segmentation. New York and London were no longer two rooms in the same building. They became separate structures. Silver sitting in New York gained a new status. It was not just inventory, it was protected inventory. Silver in London lost something vital. It lost access. This forced banks into an impossible choice. They could support London and risk trapping their metal overseas, or they could defend New York and allow London to face shortages alone. There was no neutral option. Given where most major banks are based, the decision was predictable. The United States market came first. This meant that the traditional arbitrage process stopped functioning. If prices rose sharply in London, banks could not step in with physical supply from New York. The tariff wall blocked the response. Price differences that once lasted minutes could now last days or weeks. That is how a small policy detail caused a large structural break. The tariff did not change demand. It did not change mining output. It changed behavior. And when behavior changes across the entire system at once, markets fracture. What had once been a single global price began to split, not because of speculation, but because metal could no longer move to where it was needed. Once the flow of silver slowed, the pressure moved to the place least prepared to handle it. That place was London. For years, London had been operating with shrinking physical reserves. Large amounts of silver had been leaving its vaults, heading east toward long-term buyers in Asia. Unlike short-term trades, this metal was not circulating back into the system. It was being absorbed. London's role had quietly shifted from storage hub to exit point. The system tolerated this only because of one assumption. If London ever faced trouble, silver could be sourced from the United States. That assumption no longer held. With the tariff in place, London was effectively isolated. It could not easily access American silver. It could not rely on fast arbitrage. And mining supply could not increase overnight. The city was left exposed at the exact moment demand remained strong. This is where pricing broke down. As physical silver became harder to secure in London, buyers were forced to bid higher to obtain real metal. Paper contracts still existed, but confidence in delivery weakened. The gap between owning silver on paper and owning silver in a vault began to widen. At the same time, New York experienced the opposite condition. Silver accumulated there. Inventory became sticky. Metal that arrived stayed. Instead of easing prices, this trapped supply created anxiety. Banks holding short positions realized that if London failed, they would need physical silver in the United States to protect themselves. This triggered defensive buying. Banks began closing risky positions. They reduced leverage. They stopped selling silver they could not easily replace. The very mechanism that once held prices down began pushing them up. The system was reacting to stress, not opportunity. The result was bifurcation. Silver no longer had one global price. It had regional prices. In New York, the price reflected protection and strategic value. In London, the price reflected scarcity and urgency. The same metal carried different meaning depending on where it sat. This created serious problems for financial models. Hedging strategies assumed price alignment between regions. When that alignment broke, hedges failed. Losses appeared where none were expected. Risk systems that worked for decades produced unreliable signals. The market had moved into territory without a map. The most vulnerable part of this structure was unallocated silver in London. Many investors believed they owned silver, but what they held was a promise. When confidence dropped, requests for allocation increased. The problem was simple. There were not enough bars. This is how liquidity problems become solvency problems. London did not collapse in a single moment. Instead, it weakened. Trust eroded. Spreads widened. Delivery times lengthened. The market began to ask a question it had avoided for years. Who actually has the metal? Meanwhile, the United States unintentionally built a shield. Silver inside its borders became difficult to export and valuable to keep. Industry, government mints, and manufacturers benefited from local availability. What looked like a trade dispute turned into resource protection. By the end of this shift, one truth became clear. The silver market was never as strong as it appeared. It only worked as long as metal could move freely. Once that movement stopped, the illusion ended.